Stocks and Italian and Spanish bonds in the green as the Draghi effect continues to ripple through Europe today. I'm Jamie McGeever and this is today's Market Pulse. So Spanish and Italian yields continue to fall, aided by a report in French newspaper Le Monde that the ECB and EU rescue funds are preparing joint intervention in these bond markets. A decent Italian bill auction doing no harm either. Well, I'm joined now by Ashraf Laidi. He's Chief Strategist at City Index in London. Ashraf, thanks for joining us. Spain back below 7%, Italy back down towards 6%, and the ECB hasn't spent a single cent. Does this mark a turnaround?
It could mark a turnaround because I think it would be unfathomable, Jamie, for Draghi to say these things and not to follow up. And the ECB, although it has been known for doing some things that they said they would not do, it has never been known for not doing things that they will do. Okay? So the example of the former would be they said they would not buy bonds, and they did it in May 2010. But they never hinted towards a big LTRO and never delivered. They never hinted to something big, and they never delivered. What's interesting, the ECB, anybody who's been in the market for at least 10 years would see that there has been some sort of a consistency from the Trichet ECB to the Draghi ECB, unlike the the late Duesenberg ECB. So what could they do, Jamie? Will they, I mean, one thing is to talk. I don't even need to tell you about the, getting a license for the ESM or not, because the Germans are against it. They really can do an LTRO. Not only an LTRO at the lower and improved 0.7% refinancing rate, but there is talk out there that this LTRO, if you thought the 3-year LTRO was a big shock and awe, there is talk about a 5-year.
Who's talking about a 5-year LTRO, and will that do any good? Because this isn't a liquidity problem, this is a bond yield and spread problem.
Exactly. Well, it's actually, and it's a solvency problem. I'm talking about actually two different people who have been in to Brussels and spoken with the so-called officials in Europe, told me actually that this may happen. Maybe they're not going to do a 5-year. Maybe they're going to do a 4-year. But if you remember, people were talking about a 3-month, 6-month. They did 1 year. Then when they did 3-year, why not? But yes, it could be a band-aid. It could be a giant band-aid. It could bring down the yields. But yes, it is about bringing down bond yields. And when the Spaniards came in and they said we need to bring them down, nobody argued with them, and they need to do that. However, there is the carrot and the stick approach. So the carrot is basically getting these guys, the ECB and the SM, to buy bonds and so on. The stick approach would be a good one. Would be if the Greek officials, if the tripartite negotiations in Greece agree on the 11.7 billion euro budget cuts by Monday, that would be a beautiful thing for the euro. And this thing could have legs and hands and many other parts.
Okay, well, you mentioned the euro there, and just before we came to air, it's finally getting some juice and it's back above 123. Where are the next targets on the upside?
I think we could very well see 124.50 today. When the GDP comes in the U.S., the conversation will switch like this. And it will switch, oh, the U.S. is getting weaker. Oh, the United States is weak. Let's see that. Okay, let's sell the dollar. And people would lift the euro back on the dollar weakness, yield differentials, or what have you not, and the Draghi comments. We could, the big levels of 123.70, we broke above that. So the next one is 124.70, which is right below the 55-day moving average, and also coincide with a bigger trend line. So in simple English, the big resistance is 125, but to be more precise, we could see 124.50, 124.70 as early as today, if not early next week.
Okay, and just to finish up, I know you're reasonably bearish on balance, but given the Draghi comments, some earnings are quite good. Is this a time for a tactical, if short-term, long position in stocks and banks?
Yes, it would be. Actually, look, we have been saying in City Index, even we've been quite bearish in equity, with the euro, we've been saying that S&P, we are not going to see any exciting big declines this summer, and we're going to be going from neutral to positive. So I think from the tactical, yeah, if bond yields are going to come down, you may want to dissect these things and you want to go into the financials. But if you want to play the indices in general, I think we could very well see the S&P 500 regain the 1375 or even 1375 level, and we could even see another 5.5% for the FTSE. But the key support levels, they were not touched at all in these big storm. Why? Because the moral of the story becomes whenever you see an unofficial Fed member who works at the Wall Street Journal comes out and releases these stories that the Fed could do more, or when Draghi could say I can do more, the first one to go up is stocks. The last one to go down is stocks, compared to gold and oil and the euro. So let's bear that in mind.
Okay, Ashraf, thanks very much and have a great weekend. Thank you. That's it for now, but do join us at this time each weekday for Market Pulse, a snapshot of what's moving on financial markets and why. I'm Jamie McGeever. This is Reuters.